remember you told me this, I think in '07. You told me that the financial services industry had accounted for something like 40% of corporate profits in the United States.
Yes.
Say something about that. And what you think it means.
I think it means an economy that's kind of lost any sense of what it's for.
If I can interrupt you, if you can start over and not assume that the audience has heard my question. So,
I see.
Yeah.
Okay. Yeah. So one of the characteristics of this period was that the role of financial services in the economic system grew and grew and grew, because more and more of income and profits were being kind of manufactured by taking assets and repackage them and selling them and earning fees, and taking assets and doing them again and doing that over and over again. And in order to do that, they needed to lend. You needed to create assets that people could buy and fund and sell. And so one consequence of that is that when you ran out of the natural borrowing client, someone who could pay the loan back, you went out and you found other things that you could lend against, like people who couldn't pay their loan back or might have a very difficult time. It's one of these Minsky things that when there is more money chasing things to lend against, then more assets will begin to be lent against, and the price of those assets will in the first instance rise because people are lending against them, which justifies the first loan, and so more of those loans are made and those assets rise. And we were clearly getting into that kind of a cycle. And if you look at production here, it was very flat. I mean, we were buying most of our stuff from overseas all of a sudden. We weren't making very many things. High productivity systems like healthcare were being starved of funds. Often you had to pay for them by borrowing money. Most of the there's a real shift of manufacturing purchases from overseas, all of which was easy to fund. There was a shift of things, which I thought was very unhealthy, of things that Wall Street found it easy to fund. So housing was a natural thing, because that was something that Wall Street knew how to fund. There seemed to be hard assets and so forth. So you had a huge boom in housing that made no sense at all, because previous housing booms had always been driven by major changes in the population. When the country shifted from the northeast Rust Belt and the Middle Western Rust Belt to the South, there was a huge real estate boom then, but there was a real reason for that, because you had to build cities like Houston and Charlotte really out of whole cloth. There was nothing like that going on in the late 1990s, early 2000s. The country's demographics were very stable. There was no real reason why we should have a housing boom, except it was something that Wall Street found it very easy to lend against and package and sell. So you gradually saw that the sort of financing appetites of the financial sector drove what everybody else did, and they drove that because they could then repackage those things and sell them overseas and get more money. Then we could buy more things from Asia, and they could lend more things to the people to buy from Asia, and then the Asian exporters would keep those funds and cycle them back here so they could keep the process going. But there was very little real stuff that was happening, I think, and this is not a way you can keep a country running. And then the only people who really profited from this, if you look at the income levels, the bottom 75–80% of folks, their incomes were fairly flat to even falling in real terms, while the top guys, who were mostly in the financial sector, their incomes went to absolutely extraordinary lengths. This happened once before.
When?
1920s. In both the 1920s and the 2000s. If you look at what happened, starting in the late 90s through most of the 2000s, the financial sector began to drive the entire economy. What you saw the consumer, the household sector, get heavily over-invested in things that Wall Street liked to finance. Think of what Wall Street likes to package: houses, SUVs, and toys from overseas. Those are things that they know how to fund through mortgages, auto loans, credit cards. That's what they do. They're not good at a lot of other things that maybe the country needs more of. So, and then once they could package them, they could package up those loans and sell them through the kind of process I was talking about, and they could then generate fees plus clean up their own balance sheet so they could lend more. And the guys on the other side who would buy the things that they would package were basically turned out, because they liked the way things were running too, the same countries who were selling a lot of those exports to us, so the merry-go-round could keep on running. So the consumer sector, the household sector, whose income was flat to falling this entire time in real terms, simply was able to take on more and more and more debt, and a big chunk of that debt was coming off and going into the pockets of these guys on Wall Street. So you saw a sharp chasm open between the kind of incomes that the elite financial sector guys got and the whole rest of the country got. And this happened once before. In the 1920s, you had very high corporate cash flows in the 1920s. You had flat to falling real wages. About 1925, when their households couldn't quite support all the things that the companies wanted them to buy, the banking sector invented a lot of innovative products. That was the period when they invented consumer installment loans. They had interest-only mortgages. They had many of the same kind of products that we actually saw in a bank like Countrywide, and they weren't quite as bad, but they were in that same vein. So consumer credit grew very, very fast, so we could keep the buying cycle going in 1927, 28, and 29. And when the bank loans got very shaky, they actually securitized them. They put them into leveraged investment trusts, which they sold on the stock exchange. And these were among the first things that broke in 1929 and 1930, and so forth. So it's not quite the same, but it's very much the same, really. The Federal Reserve, and there was a speech given exactly on these terms called Financial Intermediation and Complete Markets, showing how all of these new instruments were moving closer to this vision in God's eyes, and that's why things had been so calm over these past X number of years. And that speech was made by, I think it was the Minnesota governor on June 5th, 2007, which was 2 weeks before the first Bear Stearns hedge fund blew up. And Alan Greenspan talked about this many, many times. He said that the system, that we should never regulate derivatives because they are the things that ensures that risk is going to the right person, and the more that they grow and the faster they grow, the more stable and the more resilient and the safer the system becomes, and the less likely we are likely to have any kind of a terrible crash. And this was a triumph of mindless ideology over common sense that I think we've not seen since perhaps medieval Spain. I mean, it's just a bizarre consequence. And this is a case where abstract thought has done enormous damage.
And what's your view of how and why these ideas have come to take over the economics discipline and remain so entrenched?
Well, I think one reason is that, I mean, clearly, if you're somebody who's a high roller with a lot of assets in a financial market, it says that nobody should bother you. You should be allowed to do what you please, that your taxes should go down, that you're in fact a benefactor of mankind, that all those things. I mean, so that for the people who, the sort of haves, who we now say, look at what you did to the system, this was telling them that they were essentially agents for good. They were performing, I mean, not only, it's one of the first occasions that someone could make billions and billions of dollars, and as a consequence feel that he was more likely to go to heaven when he died, because of all the good things he'd done. I mean, the previous couple thousand years we used to say that it went the other way around. I think that has something to do with it. There was a lovely self-interest in it.
What do you think ought to be done about the regulatory system and about the structure and conduct of the financial services industry?
Yeah, I don't think that this was a failure of the regulatory system. It was a failure of the regulators. It was a failure of supervision. It wasn't a failure of laws. There are holes in the laws that we should fix. It's not the main event at all. Once people like Christopher Cox and Tim Geithner have talked about the power that they didn't have to stop stuff. And just look at the powers that they found once the banks started to lose money. Nobody knew that the Fed could lend, I said they've lent $2 trillion that they could buy. Nobody knew the Fed could buy mortgage-backed assets worth 40 cents on the dollar at 98 cents on the dollar and keep them on their books indefinitely. Nobody knew the Fed could become the bank where large companies can come and borrow. That's what they do now. They've got like $400 billion that are just going to corporate loans because the banks aren't doing it. Nobody knew that we could do all those things. Well, we could have stopped it. So we could have found plenty of power in 2007 and 2008, even though people said, you don't quite have that much power. Oh, we've just found it, and here's how we're going to do it. We're going to make it stop. I mean, so it was a failure of supervision. And I think it wasn't because I think Alan Greenspan and Christopher Cox hid behind their lack of power because they didn't want to regulate. Once you had this new system, anybody could find a loan, hold it for a month, get a fee, sell it to Goldman Sachs, who'd package into a bigger package, get a fee, sell it to the IBM pension fund. So that whole link was, there was no longer any link between the person who made the first loan, and nobody cared all of a sudden. Now it took 15 years before people figured out, you really don't have to care. I mean, in 1986, 1987, mortgage brokers were out there, and they were trying to make good loans because they assumed the banks were going to be looking at them, and they wouldn't buy them if they weren't good loans. And the investment banks knew they had to sell good loans to their pension funds. I think hedge funds got into the business. Lots of folks got into the business. And then, but it was still okay for a long time. In fact, homeowners saved a lot of money because homeowners were paying lower interest rates by the tune of $17 billion by 1995. I think the crisis really hit when interest rates on mortgages fell so low to 5% in 2004 that it didn't make any sense for investment banks to package them up and sell them, because the pension funds would say that's the same as I get if I simply buy treasuries, which was still true in 2004. And then some smart guy said, well, how do we get mortgages that will pay the old 8 and 9 that everybody loves? And somebody said subprime. And it looked the same. And that's what happened. And they thought, you would have thought that pension funds would have said, those are subprime, why am I buying them? And they had these guys at Moody's and Standard & Poor's who said that's a AAA. But the people had gotten used to seeing mortgages coming packaged like this for 15 years, and it worked really well. And I think that's why they sold so many of them overseas, because the people overseas, it looked just like the stuff that we've been buying for the last 15 years. And it didn't last long, because subprime started in 2004, in mid-2004, and they pushed out about $1.5 trillion worth of them by mid-2007, and bingo, the market crashed. Leverage loans, which was just precisely the same thing, but taking really bad loans on corporate takeover deals that couldn't possibly be repaid. They started to package them up in 2006, and by 2007, in the first half, they made 1.2 trillion of those in the first half. And then the market crashed and it stopped. So most of these things went out with this huge whoosh between mid-2004 to mid-2007. It went subprime mortgages, Alt-A, leverage loans, commercial real estate-backed bonds, all those things. But people were using those old packages that had worked well, but they were stuffing them up with terrible stuff because they couldn't get yields.
Do you have anything you'd like to say about policy going forward?
I think policy, I would say there's several really important things the government has to focus on. And I put them all under the rubric of making the banks shrink. They're just too much of a piece of the economy for our own good. And the ways you'd make them shrink is everything is on the balance sheet. So if you're going to, whether it's over the counter or traded on an exchange or not, if you're going to write credit default protection on a bond, then that basically says, if I do that, I get an interest payment just as if I own the bond, and if the bond goes down, then I lose that money just as if I owned the bond. Well, then you do own the bond, and don't put what you paid for the credit default, what you got paid for the credit default swap on your balance sheet, or what the current market risk, spread is. Put the whole thing on your balance sheet. That's fair, because that's the limit of your risk, and that should be on your balance sheet. I can think of 8 other things like that, where they can. I mean, the bank is supposed to be leveraged 12 to 1. When they buy for their trading account a very risky asset that a hedge fund has leveraged 20 to 1, well, put the 20 to 1 on the balance sheet, not the dollar for dollar. That's a big risk that you took. So that's the first thing. Make sure every risk is on the balance sheet in full, nothing off. Second thing is just limit leverage, and what I just said will. The third thing is probably increasing leverage, and the fourth thing is you cannot lend to highly leveraged entities. Right now, hedge funds, a lot of hedge funds, a lot of private equity funds are highly leveraged, and they trade, and the banks love this prime broker business where they handle all of that trading business. And for the 5 or 6 biggest banks, that's probably the largest source of their profit in 2007 and 2006. Well, they're at risk every day for what those hedge funds and private equity funds are doing, and they're highly leveraged guys. And you shouldn't be allowed to lend to them. Now, Alan Greenspan made, in 1988 or 1989, after people clamored for it for like 4 years, finally said banks couldn't lend into highly leveraged transactions because they were taking all the risk for the big junk bond deals. And you can do that. The Federal Reserve or the OCC or can make that happen. So don't let them lend to highly leveraged entities. If other rich folks want to invest their money in a private equity fund that's leveraged, fine. I don't think we have to regulate hedge funds much. Just don't let banks lend to them.